Tom Lee with FundStrat reiterates yet again today that stocks are mid-cycle and that there's too many top callers on Nvidia for this to actually be a top, and that there's still a lot of upside in Nvidia left to go. While yes, this may be true, and I do think there's more upside in the longer term prospects of Nvidia, expectations are definitely sky high. And I guess that's the cost of doing business when you beat on earnings quarter after quarter after quarter after quarter. Nvidia is actually down about 10% now from its all-time highs. Some of this is a pre-earnings correction, which typically happens with Nvidia. In fact, besides the last earnings, every other quarter we have seen from Nvidia, you have gotten a 8 to 15% pullback before or after Nvidia reported earnings. Last quarter, that did not happen. There was no pullback, and Nvidia has not pulled back since now. Now, some people as of recently have pointed to the insider transactions over at Nvidia to flag something that may be a problem. Jensen Huang just last week sold another $31 million worth of Nvidia. That brings his total sales this week, last week, to over $90 million. It's his largest cluster of sales in 19 years. Again, just to stay neutral here, there can be 1,000 different reasons why you sell a stock. Your kids are getting married, you gotta pay for college, you want a new house, you want a boat, you wanna go on vacation, so on and so forth. So it doesn't necessarily mean something is wrong at Nvidia, but I think Jensen Huang believes himself that the good times are not gonna be good forever. And there will be a down quarter. Whether that's this quarter, next quarter, or the quarter after that, statistically, it's pretty unlikely that things just are smooth sailing for, call it, another year. So why not get out now, as Nvidia has become the most valuable company in the world? And again, this is a very, very small amount of Jensen Huang's overall position in Nvidia, but still worth mentioning. And it's definitely not helping investors be more confident buying Nvidia at all-time highs. But forget Nvidia for just a moment. This, to me, is a little bit more concerning. This is what Stanley Druckenmiller said about the 1987 stock market crash. It's a segment from his book that he says, quote, "It was a combination of a number of factors. Valuations had gotten extremely overdone. The dividend yield was down to 2.6%, and the price to book value ratio was at an all-time high. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. That is, the market strength was primarily concentrated in the high market capitalization stocks, with a broad spectrum of issues lagging well behind. This factor made the rally look like a blow-off. Whether you're looking at the percent of stocks above their 50-day moving average, sitting at some of the lowest points we have seen in 2024, at the same time the S&P and the NASDAQ are less than 1% off of new all-time highs, or whether you want to look at non-farm payrolls that are lagging a recent spike in initial jobless claims, or maybe the plummeting in Michigan current economic conditions being kind of ahead of some of your other lagging data, or when you look at the S&P 500 trailing price to sales ratios that are higher than where they were during the dot-com bubble, again pointing to a market that's pretty expensive. I mean, the facts are the facts. The 1987 stock market crash resembles a lot of what we see today in our markets. Now again, just for the sake of neutrality here, I do believe there's quite a few differences as well as the overall psychology of investors then and now. Investing is a lot more mainstream and well adopted today than it was then. Investing is a lot easier today than it was then, giving more people more access to generalized markets. So does that mean we're guaranteed to see a 1987 style of crash again? Absolutely not. Ryan Dietrich posted this on X and said so many are wondering why stocks are up 25% last year and another 15% this year. Here's a hint, and it's forward earnings expectations that just continue to move in a straight line higher. The danger in our markets is if maybe expectations got a little too high. That's why every spending data point, every retail sales data point, every GDP report, every earnings is so closely scrutinized by markets, because that's not sustainable forever. And eventually there will be another 1987 style crash. The question is, how long do stocks continue to rally? If you sell now, how much upside do you risk losing out on compared to protecting what could be a lot of downside when that does come? And judging off of the fact that just last week we had the largest weekly inflow ever to US growth funds, Wall Street's not budging. And if you are a contrarian by nature like I am, it makes you a little bit more defensive. It makes you sit back and say, is there something that Wall Street is missing? And personally, if the labor market weakens further, the unemployment rate rises further, that is something that Wall Street may be not giving enough credit to as far as a downside catalyst right now. The Kobisi letter on X wrote this. They say this trend is concerning. For the first time in 4 years, the US unemployment rate has crossed above its 36-month moving average. In previous economic cycles, every time this has happened, a rapid spike in jobless rates followed. This has also coincided with the economy falling into a recession. The unemployment rate has been in an uptrend since April of 2023 and is up from 3.4% to 4%. Meanwhile, 1.5 million Americans have lost their full-time job in just 6 months. Is the labor market beginning to crack? And here you can see is the actual chart, and it's pretty spot on. Anytime you break that moving average to the upside, you do tend to get a sharp uptrend in the unemployment rate. This, I think the markets may be overlooking a little too much. Again, with the perceived narrative that there is no chance of a recession within the next 12 months. When in all reality, I think there's probably a 50% chance of a recession within the next 12 months. As the markets start to get more data that suggests maybe a recession could be coming, as those odds start to rise from 0% today, again, if you're looking at the S&P or the NASDAQ on a headline basis, that's important, we'll talk about it in just a moment, starts to rise to 10, 20, 30, 40, 50%, that's where you start to get material downside in markets. Because why? Earnings expectations will start to come down from where we are now, which is a very historically unprecedented expectation. We're expecting close to 15% earnings growth this year and another almost 15% EPS growth for next year. If we progress throughout this year, and it looks like we're going into recession, that 15% expected EPS growth rate could easily drop to 10, if not 5%, let alone negative, and you're in a really bad situation. Now again, is that guaranteed to happen? Absolutely not. But just falling from 15% expected growth rate next year for EPS to 10, a historical, still high number at 10, that would be insanely problematic. And what makes matters even more interesting is the S&P 500 hasn't declined by 2.05% or more in 377 consecutive days, the longest stretch since the global financial crisis. So by that metric, people are balls to the walls in stocks. And we really haven't seen any fear in a long time. Besides, if you look at CNN's Fear and Greed Index that is currently at 41, which is in fear territory. I've never seen that before, where CNN's Fear and Greed Index is in fear territory, as the S&P and the NASDAQ have had such a great year. But again, when you look under the surface at the percent of stocks above the 50-day moving average, only at 39.2%, over 60% of stocks are in a large downtrend. I don't think that exactly sets markets up well in the short term. But hey, I could be wrong. You never long-term want to bet against the US economy. You have to be invested in our markets. But from time to time, things do get overextended. And unfortunately, I think that's where we are now. After all, I did post this video titled "The Next Crash Could Be Coming Soon" 6 days ago. As another anecdotal sign, that video really underperformed the others that came out the day before and the day after. And since that video has been published, Nvidia is down 10% and could see more downside. And yes, in that video, I was specifically referencing Nvidia and your AI stocks being too overextended as the broader markets were basically collapsing internally. From my experience, that never ends well. Oh, and you also had Jim Cramer that said, Nvidia, own it, don't trade it. So far, so good. And the inverse Cramer effect means Nvidia is gonna crash, obviously. Jason Goepfert wrote this post on X that says, I mean, it's probably something. That's what he says, not me. Nvidia insiders are dumping at the fastest pace in years. The other times it exceeded 150 million during a month, the stock got put in the penalty box. And here you can see other instances. That was to start 2022. The stock clearly did not do well during that period of time. During really the end of 2023, there was a lot of volatility and quite a bit of selling as well. And even just more recently to start 2024, before that, 10% or so correction that we've seen before Nvidia earnings. And now it's the most we've seen in recent history. Michael Brush on X comments on this and says, from 1990 through 1995, Bill Gates sold 1.13 billion worth of Microsoft. By 2023, Microsoft was up 14,855% versus the Nasdaq's 2,280% return. How meaningful a signal is insider selling in tech? And this same user that posted the chart says, I could play anecdote versus anecdote, but your point is valid. In aggregate and over long time frames, the efficiency is low. On shorter time frames, there is more of an argument to be made, specifically with super high flyers. So again, this means nothing in the long term, but in the short term, it could be a negative signal. And really by short term, I mean like 1 to 12 months. That's pretty short term if you're actually investing in our markets. So from that sense, it's the short term that I'm more concerned about than even next year or 2026 for that matter. I think by then inflation's gonna be no longer a problem, it's gonna be gone, rates are gonna be low, and stocks are gonna be in a broad-based bull market. But what happens between then and where we are now? That's where it gets a little dicey. Gunjan Banjuri, maybe I butchered that. Sounds right, but who knows? She covers markets and money with the Wall Street Journal. She put this post out on X that says, quote, net call volumes in mega cap growth and tech surged this week to record highs, going above even pandemic boom levels and completely disconnected from those in the rest of the markets. And yeah, from this chart, I mean, you could see just what happened. You've actually seen a decline in the net call contracts for the rest of the S&P 500, but just the soaring of Magnificent 7 and overall tech. From these statistical data points, it does look like we have seen a blow-off top rally. Last Friday's option expiration was actually the largest in the history of the markets, and it was worth over $5.4 trillion. Now let's think about this logically. Those calls helped push the markets higher as that $5.4 trillion of value expired, was exercised, just sold out of. How is that money likely going to position back into markets? Is it going to continue to be super bullish, or are there signs that maybe things are slowing down? Maybe the economy's getting worse. After all, the unemployment rate is up quite a bit. Especially heading into earnings season, it would make sense to be a little bit more defensive as expectations are this high. So on a statistical probabilities metric, I think the statistical probability of a more defensive positioning of that $5.4 trillion is more likely than not. Which, yes, could give you some downside in markets. I mean, after all, if you look at the US Chicago PMI, the business barometer that is currently at 35.4, deep in recession territory, I think you would be a fool to not look at some of these things and say, yeah, everything's great. No recession is even possible. That would be delusional, right? Well, that's kind of how markets are priced. In fact, not kind of, like that is how markets are priced, as if there is no recession even possible, at least in your big tech names that control the broader weighting in the S&P and the NASDAQ. Again, if you look under the surface of this market, it's been a bear market for over 2 years now. And again, that's why I do believe once you get the next big crash, the next 20, 30, 40, 50% downside, which could very well happen if expectations are this high and the reality is way lower, go into recession, Fed makes an error. There's so many different things that could happen. I don't want to speculate too much, but there could be a real doom and gloom scenario over the next 12 months. The bright side is after that, I think you get a broad-based bull market that could last a decade or longer. And it very well could be one of the last great buying opportunities. Instead of 5 or 10 stocks carrying the markets higher, I think it's going to be 90% of stocks, at least 80% of stocks carrying the markets higher. Those companies with improving fundamentals will start to be rewarded, whereas they have not been over the past couple of years. You can look at a SoFi or look at a PayPal, look at a Square, look at some of these companies that have done really well that have not been rewarded at all. Specifically a stock like PayPal that Tom Lee calls a granny shot that has done nothing. That's trading at a very low valuation based on where other, peers are trading at. Those kind of stocks will do very well in this new broad-based bull market that I am predicting will start after the next big reset. The Kobisi letter on X says, what's the probability of a recession within the next 12 months? According to the Fed model, using the US Treasury yield curve, there is a 52% chance of a recession over the next year. This is down from 71% at the peak recorded in May of 2023. Over the last 40 years, each time this probability has exceeded 30%, the US economy experienced an economic downturn within 2 years. Meanwhile, the yield curve has been inverted for over 700 days, the longest stretch in history. A soft landing may still be difficult to attain. As I mentioned in previous videos, if we take a look at the S&P 500 or the SPY ETF and take a look at the option activity for this upcoming Friday, you can see there's over 5 times as many puts than calls. That means open interest on the call side is 16.56%. Open interest on the put side is 83.44%. And a lot of people have made the argument, well, if you're a contrarian, doesn't this mean markets probably go higher? And although that is possible, but in the context of what we seen last week with the largest inflow ever to growth funds, a very bullish ratio of calls to puts. There was like 5 times more calls than puts last week. Considering that, I don't think you can use the same precedents for this upcoming week, because everyone was already super skewed to the bullish side. Now it's super skewed to the bearish side. As that money repositions, I think it's giving you a brand new set of positions. Even to point out what you've seen on Friday, you had 28 orders totaling $7.21 million with a positive order value of 20%, which means 80% of the option activity again on Friday was negative. Now, again, I think for Tesla stocks specifically, we're kind of handicapped to whatever the broader markets do until July 2nd, until we get that Q2 delivery number. Then Tesla will make its own independent move higher or potentially independent move lower. And as this $5.4 trillion does redeploy back into our markets, I think it will take a little bit more of a defensive stance, and that could be problematic in the short term. Again, as I mentioned in the last video, there is going to be economic data this week that will be important, as well as earnings along the lines of FedEx, Tuesday and after hours. Wednesday and after hours, you will have Micron, which will be important for the overall AI trade. And then Thursday and after hours, Nike, which is important for your consumer kind of discretionary stock. The way that I look at markets right now is we're very offsides with the expectations of earnings and economic activity being so high and so good, which again, that's been powering our markets higher for some time now. But I think we're so offsides here, it's pretty bad, where the risks really seem one-sided. I think the risks is not that we're pricing in too little. Imagine that. Imagine I'm making this video and we're not pricing in enough good news, rather than, again, we're pricing in not enough bad news. I think we're not pricing in enough potential bad scenarios for stocks over the next 12 months, or for the economy, really for the economy, which, makes its way into stocks eventually. And all of this data just seems not great. The only thing that if you're a super bull you can point to is, statistically, election years are good years. Statistically, I mean, July, the first half of July, is the best period of the year for markets. And while that is true, all of the other data points to negative things, right? There's not too many positive things you can say, again, with expectations this high. If expectations were lower, then sure, like 7% EPS growth, 10% EPS growth, maybe there's some room for, upside there. But already pricing in 15% for this year and next year, with elevated odds of a recession that the markets are not pricing in. And I'm just not that optimistic for stocks where they are now. But again, I do want to make it very clear. Once you get that big crash-like event, because I think there will be a day of reckoning for markets, I do think expectations will prove to be way too optimistic compared to what we actually get. After that crash, it could be 20%, it could be 30, 40, or even as much as 50%. We could go back to the lows of 2022 if we do go into recession. That would be about a 50% down move from today's levels. Then I think you will get a broad-based, healthy bull market for probably a decade, probably the next 10 years. Now, this could start in 2025. It could start in 2026. But I do think that will happen. Not just the top 5 or 10 stocks leading the markets higher. It will be 80 to 90% of stocks actually in an upwards trajectory. A lot of stocks in our markets have actually had their fundamentals improve, like a PayPal, for that matter. And they have not been rewarded from it, because all the money is going into the highest market cap companies, as we went over here in this video. So I think there is a bright side to all of this. It's not all doom and gloom in the short term. It's definitely a little bit more doomy than gloomy, but give it a little bit of time, 12 months from now, 18 months from now, and you could find yourself firmly in a very strong bull market. And I do think, again, a lot of the markets are already pretty well priced for a recession or bad earnings, whereas the areas of the markets that actually move the markets, like big tech, are not at all. So I still think Tesla can do very well over the next 12 months. And even if we do get a 20-30% crash from here, it doesn't necessarily mean Tesla or even the broader markets need to do all that bad. Now, it depends why things are crashing. If the AI enthusiasm is overdone and the economy is okay, then maybe the crash isn't as severe for Tesla and the broader markets that haven't got any AI love to begin with. If you go into a recession, or it looks like we're going into recession, the Fed cuts rates because they made an error, then you would be looking at potentially a larger, more broad-based crash event. But we'll see. I know I'm early. Yes, I'm early. This will happen. I am early. And maybe it doesn't happen this week necessarily, but over the next couple of months, I think what I'm saying will become more obvious to all of Wall Street and inevitably all of you guys as well. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come join the trading community, check out that link down below in the description of this video. This week is going to be a big week, and let's see if we can hit some big trades, some big winners. That's definitely ideal. Nonetheless, most importantly, enjoy the rest of your day, and I will see you in the next one.